Alright guys, just wanted to introduce you guys again to Josh Land here, one of my preferred mortgage providers. He does a great job for my clients. He had that $2,000 grant program that we talked about in our previous video, but now we really need to dive into what is needed to get you that pre-approval letter. Why is it so important in today's market to have that when you start writing up an offer? And we're starting at this point because this is truly the first point that you need to look into when you're thinking about buying a house, refinancing your house, or anything. Like you really gotta grab your mortgage broker, you gotta talk to your agent. This is step number one. I want to let Josh kind of take the reins here with what do you actually need to get a pre-approval letter?
Yeah, I mean, to your point, this should be the first step in the process, because one of the most frustrating things in a process can be, looking at something that you end up finding out is outside of your price range. And it can be tough then because it's hard to go backwards from that point, right? So I think understanding what your true buying power is when you start this process is really important. And I think that's one thing that can differentiate, myself from a, national mortgage company that's just going off of stated income initially. I want to get a true pre-qualification for you guys, and that's important for a variety of reasons, but basically the most important reason, and throughout this entire process, nobody likes surprises, right? So have a true understanding of what that buying power is. So again, it's fairly easy if you're a W-2 employee. We're talking typically 30 days pay stubs and 2 years W-2s. And at that point, when you go self-employed or otherwise, it can get a little bit more tricky to be able to prove that. But I think that's the important piece that you need to think about, is making sure you truly understand what you're qualified for. And that's making sure we have everything done on the upfront phase. And self-employed, making sure we've got 2 years taxes, we understand what you wrote off, what we can potentially add back in to make sure we are truly getting you qualified for the amount that you're looking for.
And probably, as you saw, he looked directly at me every time he talked about self-employed. So, as a real estate agent, when you make that transition, I'm now technically full-time self-employed. So when it comes down to it, dive a little bit deeper. The W-2 is a little simpler, showing that proof of funds. We'll start there. When you're looking at proof of funds, can you look at just the husband's side of things, or to make it, what would make it the best interest to only look at half of the income compared to both the husband and wife?
Yeah, so I mean, there's a lot of different things that we can look at, right? And some of that, I think most importantly, what's important to you? What are you trying to accomplish here with this home purchase? You're absolutely right. We can certainly look at husband or wife individually. That may make sense if one, either husband or wife, can qualify on their own, and the significant other has, a credit history issue, where, they're going to have a higher interest rate if we have them on the loan. If we can get them qualified individually, we'll certainly look at that. In the state of Nebraska, husband and wife, obviously, they still own the property together, but that doesn't mean they both have to be on the loan. So that's a very, very good point. But there are situations where it does make sense, even for a husband and wife, to look at doing financing separately.
Yeah, and that's kind of piggybacking off of that, is that Nebraska is one of those rights to survivorship states, where essentially, if your husband buys the house before you're married, as soon as you get married, if something happens to either spouse, the other spouse gets 100% equity on the house. So the husband bought it by himself through title 2 years before he got married, but then he got married, and the husband passes away or is no longer here. The wife now takes control of it, even though she was not on the title, even though she was not on the original loan. She is the survivor of the relationship, and she takes control of it. So past the W-2 form, so what are some of the things that you're looking for? What do you advise people to start putting together for you for your first meeting, so that no one's surprised, like, oh, I left that back in my piggy bank,
right?
Or
yeah. So on an initial meeting, again, we talked about 30 days pay stubs. So if you're paid once a month like a teacher, at least one pay stub. If you're paid every other week, 3 pay stubs at that point. 2 years W-2s. It'd also be helpful to have 2 months worth of bank statements for the account that the down payment for the house is going to come in. So we need 2 months worth to just kind of get an understanding of, the deposits and the credits that came out of that account. In most scenarios, it's okay to have a gift for financing, but we do have to know kind of where that comes from. And so that's something that we would certainly talk to you about. And then obviously having IDs as well, making copies of those on an initial conversation, so we have that down the road. But the biggest things, at least to get a initial pre-qualification, is verifying the income, how much you're making gross. It is gross, so pre-tax what you're making, and then doing that credit check and making sure we have a full understanding of the credit situation, where you're at credit score wise, and then obviously, what besides this new mortgage you have that you're paying on a monthly basis, whether that be credit cards, an auto loan, otherwise, to determine your debt to income ratio and what we are truly calling kind of your buying power for this home purchase.
With that credit check that we're talking about, I bet people always come in and they're just like, well, I did this free credit report on all that stuff.
Credit Karma,
all that stuff. What happens during those conversations? Is it exact every time? Is there a difference in what's actually true?
Sure. I mean, it's never going to be exact every time. I mean, I think it's a good barometer. I do think it's a good idea for you to have an idea of where you're sitting with your credit, really, at any point, right? What goes into that? What we're going to look at, obviously, we're going to look at all 3 credit bureaus. We're going to take the middle score of the 3 credit bureaus. And if it is a husband and wife, we take the lower of the 2 scores. So it is important when you're looking at your financing situation. It doesn't, it's great if one of you has an 825 credit score, but the other has a 650. I mean, it's important that you're both keeping up on your credit. And there's certain things too that we can talk to people about if they're looking to get pre-qualified. There's some recommendations we can make to help you, boost your credit. Can't guarantee anything, but by doing X, Y, and Z, we have a pretty good chance of seeing your scores raise, which will in turn, qualify you for this lower interest rate. So there's a lot of things that we can do and kind of talk you through and coach you through to make sure, again, you're getting the best interest rate and in turn spending as little on interest over the life of the loan on this home purchase.
And with that all being said, we're going to switch over to that self-employed, because that kind of covers the basics on being employed. You have your employer, you get those monthly, weekly, bi-weekly pay stubs. But say you're like me, you're self-employed, or you're looking into becoming self-employed, but your future does include purchasing a house, helping build your equity that way. We talked about, we have to prove 2 years of income. It's not so much a 1 month pay stub, because in real estate, I mean, everyone knows it starts to pick up during the summer and then cools off a little during the winter. You wouldn't have thought that with how the market's been now, but can you kind of walk us through why you guys need that 2 year and how you really look at the numbers and how someone who's self-employed, such as myself, can get that pre-approval letter and buy a house?
Yeah, I mean, absolutely. So when you're looking at, I mean, the reasons why we need to, 2 full years taxes is obviously we need a full snapshot as to kind of what came in from the business, or in your case, how many houses you sell this year, John. But we need to have an idea where that's at, and then also what's being written off. Again, by getting the full taxes, there are some things that we're able to add back in that are written off of your adjusted gross income. And in all cases, we may not need 2 years, but I always like to have people bring in 2 years W-2s, 2 years full taxes in the case that we do need it. But other than the taxes, I mean, that's the biggest difference you're going to see from a self-employed. And then throughout that process, depending on what time of year we're doing, we're also going to look for a profit and loss statement of some kind, showing, that with this business, you're kind of still on track to make a similar amount in 2021. So to kind of get an idea of where you're sitting from that standpoint too. So with a pay stub or a W-2, a pay stub for a traditional employee, it's going to show kind of a year-to-date earnings, right? And this profit and loss statement is a way for us to kind of verify the same thing for a self-employed individual.
Yeah, I mean, that's a lot of things that I switched over. There's a lot of information that I've learned from Josh about going self-employed, because I did not know about that. And people that are looking at that transition and stuff, there's a lot of opportunities and a lot of jobs that you would not expect to be self-employed. I mean, you could be an electrician, you could be a plumber, you could be a handyman. You look at guys that do lawn services and stuff. They're outside contractors, and hundreds of them, if thousands of them, across Omaha. Now that we kind of talked about what you need to bring to the table for that first meeting, let's go into a little bit how that meeting goes. How do we approach people? Are we going to tell them you're pre-approved for $230, so we're going to buy you a house at $230?
Yeah.
Or how's that conversation going to go with you?
No, again, so I think that's a really good point. Basically, what are you wanting out of this process, right? At the end of the day, probably what's most important to most of you is, what am I going to be paying a month, right? And I like to have that conversation with people, because just because I can get you approved for, $300,000 doesn't necessarily mean that that's a payment that you're comfortable with, just because your debt to income ratio says that you're comfortable there. And there's a lot of things that go into your payment, right? You've got your principal and interest on the actual loan itself. You have the items that would go into an escrow account if you're escrowing, your taxes, your homeowners insurance premiums. You may have private mortgage insurance if you aren't putting 20% down. So there's a lot of things that affect that payment. And I like to be able to have a conversation and really try to understand, where are you going to feel comfortable on a monthly basis with a payment? And it helps me to start to kind of build a picture. I have an idea based on the price range that you're going to be in, what your taxes are going to be if you're in Douglas County or if you're in Sarpy County. If you're going to be in an outlier county, I mean, we can figure out an idea on kind of where you're going to be, and then where you're going to be with your homeowner's insurance premiums. But it's important to be able to have that conversation and just really find out what your expectation is, what you're wanting to pay on a monthly basis, and all of the pieces that go into that. And so that conversation, this first conversation, is very much trying to get a feel for what your expectations are, and then at the same time, I'm setting up your expectations for, what we're going to need from you throughout this process to meet this closing date. Because John's going to help you work with the listing agent or with the buyer to set up a time frame. You know, obviously right now, with as busy as everything is, appraisals are things that fall into an equation, right? For the most part, you're going to be dealing with John and myself for 6 weeks or so. Maybe a little bit faster if it needs to be that way. But we're going to kind of walk you through what steps are going to be happening in that process. And that's something that I talk through with you very much on an initial meeting, just so you don't have any surprises here during this time that we're spending together.
And kind of jumping onto that, when you have a mortgage broker, you really got to make sure you have an agent that can communicate really well. I mean, Josh and me, we text each other, we call each other on a regular basis. I'm not going to pretend I'm an expert in what he does, and I want to call him and be like, I want to double check on everything to make sure you don't have any problems in the end. And also at the very beginning, he's going to talk to you about setting expectations on what your monthly payments are going to be like. And then you are going to have a conversation. Well, you're pre-approved for $300,000. After you talked about everything, your monthly payments, you're more comfortable doing that $250,000 range. When we come down to it, with the current market, how it is, I'm going to start you off and be like, you know what? You're looking at the $250,000 range, trying to keep your payments at that point. We need to be looking at houses in that 230, 240 range. We can creep closer to 250, but most of the time, unless it's a closed deal where I'm able to sneak in and call a renter that's a rental owner that said, "Oh, I'm actually looking to sell this house," like, well, it's not on the market, we can go and get it without having a bidding war going. Or we have, I know of a seller that's like, I'm testing it out, I don't want people walking through my house during COVID, I can bring you to that house and we can get you that $250. But in most cases right now, we're going to have the escalation clause and different things like that are going to bring up that price. So going back to that 230, I'm going to be communicating with you. I'm going to talk to Josh, be like, okay, they're pre-approved for 300. Let's look at the 230 range. We're going to probably put a house, like normal house, we're going to say, we'll write our first offer with the escalation clause going up to 240 or 245. It's not unheard of for houses to go $10,000, $15,000 over asking. Right now, if we can get it for less, great. That's how escalation clauses work. But it's setting that expectation and not putting you in a position that you're going to regret. Because we don't want to see you put in a position where you're now having trouble doing some of the things you love. You want to be in that 250 range because you love to travel. You want to have that extra payment. You go to Colorado and ski. You go hiking in the Black Hills, you go deep sea fishing once a year with your family.
Sign me up for that. No, I think too, one thing I want to point out really quick in this conversation is, again, I alluded to some of the prepay items, but you're going to get a fee sheet for every offer that you're making with me that gives you a true understanding of what you would be bringing to closing, to closing on a house where you're putting 10% down, where you're putting 20% down. To make numbers simple, if we're talking about a $200,000 house, right? If you're putting 10% down, you're not just bringing $20,000 to the table. We talked about the fact that you're going to have to fund an escrow account, which means 1 year insurance premium plus a couple months. And then, between 6 and 9 months of your taxes. You need to figure all of that in too when you're making that offer, and it's important to not have any surprises. And so we're going to have those conversations. Make sure when you're making an offer, you fully understand what that means to you from an interest rate wise, from a payment standpoint, from a, what you're going to have to bring to the table at closing. All of these things you have to consider when you're deciding what you want to make an offer on a specific property.
Exactly. And I mean, going off of those added costs with getting your mortgage, there's also costs that beyond your down payment that you're going to have to pay on your house. If we're able to get you an inspection on your house, those go for about $500. You go for termite inspection, that's $90. You do a radon inspection and do all these different things that add money that you have to bring to closing. This is not something that you can add to your loan. It's something, a lot of these are prepaid before your house closes. So that's setting the expectation with that. Is that, do you have enough cash to do these inspections that you want and still keep the loan that you want and not have it affected?
Yeah, at the end of the day, it's a fun time to be looking for your house, whether it's your first house or your dream house. You know, enjoy the process, and you know, when you've got a real estate agent at your side, and then, I mean, my job basically at the end of the day is to make sure you don't have any surprises with your financing, and we'll make that happen for you. But certainly enjoy this process. It's a fun time for you for sure.
Yeah, I would agree with that. That's why I love doing what I do, and I'm going to continue doing it. All right, guys. Well, we'll bring you some more information soon, and hope this helped a little bit.